Welcome to Zero. I am Akshat Rathi. This week, hurricanes and Wall Street. Hurricane Milton has caused widespread devastation across Florida, and that's just weeks after Hurricane Helene. This is an example of compound climate events, one disaster hitting soon after another. Something that we've discussed on the podcast before. If you missed that episode, we've linked it in the show notes. Today, we want to talk about what Wall Street is doing in the middle of these natural disasters, hurricanes in particular. There's a whole market of special financial instruments that can help people who've lost their homes rebuild or make investors rich. It all depends on the details. My colleague in London, Gautam Naik, has been reporting on this area. It includes the kinds of insurance you're familiar with and the growing market for things like catastrophe bonds. And this is a global story because Wall Street is selling these not just to rich countries, but also climate vulnerable nations that are desperate for any kind of help they can get. So this is the first time we've tackled insurance on Zero. And before we get into the bigger discussion, let's just go over the basics. What is the easiest way to understand the financial instrument that is insurance?
So there are risks in the world, whether it's a natural catastrophe or a car accident. An insurance company essentially wants to spread this risk across a whole lot of people. So everybody pays a premium, and the insurance company is betting that only a few people will actually get in an accident or have their house roof blown off, so they would pay those claims. But ultimately, the total amount they pay out in claims will be less than the amount they can collect from the premiums. So they will stand to make a profit at the end of it.
Right. So if I had car insurance, and I don't because I don't own a car, but if I had car insurance and say the probability of me getting into an accident is 1 in 20 years, that means roughly my premium would be 1/20th of the damage my accident may cause. And so I'm paying that over 20 years, and at some point I get into an accident, and then fortunately I'm not paying that huge amount because I've been paying the small amount all through my time, and I am saved from that risk. Great. Lovely to have insurance. It sort of makes the world work better. But now, what if suddenly we realize that there's a software glitch that car makers have introduced and all kinds of cars are crashing and insurance companies aren't ready to make such large payouts?
Well, it means that the insurance company is on the hook for a lot of money, much more than it anticipated. And so they have different ways of dealing with this. They buy insurance from other companies, which are known as reinsurers. And so that allows them to spread the risk of this kind of calamity you're describing, which is sort of a black swan event, which they weren't expecting, pass on that risk off their balance sheets to some extent onto other people willing to take on that risk.
And can the reinsurers be wrong, and do they have somebody to protect them?
Absolutely. All players in the insurance market are extremely risk averse, even though risk is what they deal in. So even reinsurers buy their own insurance. They buy it from companies called retrocession, the retrocession industry. And that's how they pass on some of their risk to other parties.
How many layers does this onion have?
It more or less stops there.
Okay. So insurers have insurers have insurers, and that's about it. But all this year, you've been reporting on an instrument called a catastrophe bond, which is a type of insurance instrument. And I've read those stories with great interest because on the one hand, they could really help people deal with climate catastrophes that we are facing increasingly. But on the other hand, you've been showing how hedge funds are actually making a ton of money from this instrument. Now we are watching the fallout from Hurricane Milton. And it looks like catastrophe bonds could be playing a role in how Tampa and St. Petersburg and those areas recover from this disaster. So let's start there. What is a catastrophe bond, and why is it different from the types of insurance instruments that we've been talking about?
So regular insurance, in the example of your car, is something that the risk is usually taken on by the insurer, right? It goes on their balance sheet. And if you make a claim, the money comes out of their balance sheet to pay you. Well, there are events in the world that are extremely large, very hard to predict, rare, and really black swan events, like a massive catastrophe, that insurance companies don't want on their balance sheets. It'll wreck their finances. So what they want to do is they want to pass that on to some other group of people who'd be willing to take on the risk. And that group is Wall Street. There are investors there who are much more happy to take on risk as long as they get a good return. A cat bond is the instrument that allows insurance companies and sometimes governments to pass on the risk of these very rare black swan events to Wall Street, to the capital markets.
And this is a more recent development in the insurance industry than insurance as a whole, right?
It is. I think goes back to the early 90s. I think it was Hurricane Andrew that really sparked an interest in this, where there were predictions by the insurance companies that even if a large hurricane, very large hurricane, were to hit the US, it wouldn't cripple them. In fact, Hurricane Andrew did. The losses were much greater, and suddenly these insurers realized they had to find a way to pass on the risk of these catastrophic events to some other party, and it ended up being Wall Street through cat bonds.
And Hurricane Andrew hit Florida, and Florida, of course, even today is sort of dealing with the impacts of that insurance payout, because getting insurance in Florida is getting harder and harder. And now, cat bonds themselves cover all kinds of events, right? It's not just natural disasters, it's not just climate-linked disasters. What other types of events does it cover?
Well, earthquakes, for one. That's one of the main, large, unpredictable events that cat bonds are used for. But there are also cat bonds that cover what are known as secondary perils, so things like floods and wildfires and storm surges. So you do have cat bonds that cover these kind of events, but the market is increasingly shifting to these more rare, one-off Hurricane Katrina-like events, which cause a great deal of damage but only occur occasionally.
Well, you use this term secondary peril. It feels a little wrong to say a flood is a secondary event, whereas what is a primary event and why that distinction?
Yeah, so originally hurricanes and earthquakes were called primary events and all these other events were called secondary. Well, that distinction has changed. I think even insurance companies no longer refer to them as secondary perils because climate change has engendered more flood events, wildfires, storm surges, and the industry losses in the insurance for the insurance companies has gone up so much that they no longer consider them secondary.
So is the cat bond just like normal insurance? Say a car insurance where if I get a scratch or a crash, I'll get the pay for whatever accident I get into.
Actually, cat bonds are highly specialized instruments. So some governments issue them to protect themselves against very large natural disasters. The way these work are through a particular parameter. So if a country like Jamaica is going to be hit by a hurricane, the cat bond will have in the documentation a particular parameter, in this case a pressure reading. If that pressure reading is hit by a particular storm, then the cat bond pays out. If it isn't, then the government gets absolutely nothing. But the vast majority of cat bonds in the market are dominated by US storms. And these are structured somewhat differently. They have different thresholds, but if there is a certain amount of damage, then the cat bond pays out a certain amount. And if there's a higher level of damage, it pays out a bit more. But there's no parameter involved. This actual real world damage has to be assessed for the issuer to get some money.
So in the case of a parametric cat bond, it will be paid out as soon as this particular parameter is hit. Whereas in the case of a threshold cat bond, you actually have to wait for the damage calculations to come in and then make the payouts.
Yes, and that's exactly why developing countries really like parametric-based cat bonds. They don't have too much money in their treasury, so when disaster hits, they need to rebuild quickly, and they can get the money very quickly through a parametric trigger because it's pretty easy to determine whether the cat bond is going to pay out or not. By comparison, the cat bond that, say, would pay out in the case of a big earthquake in California or a hurricane in Florida is determined by claims adjusters actually going out in the field and calculating what the real insured losses were, and it's on that basis that it'll pay out. That process can take, if not weeks or months, sometimes even years.
In general, the cat bond is a higher risk, higher reward strategy. And that's why Wall Street has been interested in these instruments. In your reporting, you found that in 2023, cat bonds proved to be the most profitable strategy for hedge funds. Why was that?
So the cat bond is made up of two components. One is the investor gets a risk premium for taking on the risk of these cataclysmic events, and they demand pretty high rates of return, and they're getting them. But on top of that, they also get the current treasury rate, and we know that interest rates have been high for a long time. So when you put the two together, they've been getting rates of up to 20% on their investments. And as long as a catastrophe doesn't occur, they keep getting this money in for 3 years.
So last year, the places that had cat bonds did not suffer from as many climate catastrophes, and thus the cat bond investors made a ton of money. This year, with Hurricane Helene and Hurricane Milton, should Wall Street be preparing for major losses on their cat bonds instead?
So there's a significant amount of luck involved in cat bond investments, and that's why they're a very niche market and not for just about your ordinary investor. Now, the way it's working out with Milton so far, it looks like the estimated insured losses are anywhere from 20 billion to 60 billion, which is much less than the 100 billion or 175 billion that was forecast for the top end. And this translates to a loss of anywhere from 0% to 4% for a cat bond portfolio, which is not very much, given that this year cat bond investors are bringing in about 12.5–13%. So if there are no further big hurricanes and losses, and they continue to get this rate of return, they will end the year at roughly 9% up.
That feels kind of unfair. You have people suffering, and yet Wall Street is making money.
I don't think it's unfair because cat bonds are a specific instrument for very rare black swan events. And when they do occur, then the investors will suffer tremendously. They could lose their entire capital. You never have that with any other kind of fixed income or bond investment. But here you have a very high risk, high reward scenario. So for taking on this crazy amount of risk, they demand high amounts of returns.
After the break, we talk about the use of cat bonds for poor countries and whether they can serve as a solution to deal with climate-linked damages. Gautam, a separate story that you've been reporting on is Hurricane Beryl's impact on Jamaica. It did not hit Jamaica directly, it kind of whisked past, but it still caused the worst damage that Jamaica has suffered from a hurricane. And Jamaica has a cat bond, but it did not trigger the cat bond. So the people lost and the investors won again. What exactly happened?
Yeah, it's really important actually to point out that most cat bonds are issued in the developed world for earthquakes and hurricanes and windstorms. But poorer countries are starting to feel increased losses from climate-related events, and some are turning to cat bonds as a possible solution. And the World Bank has been promoting this as an instrument for various countries.
And developing countries haven't turned to insurance yet because they just can't afford the premiums, right? It's sort of like developing countries are uninsured, whereas developed countries are insured.
That's right. I mean, big insurers barely have operations in most of the poorer countries of the world. And when it comes to climate risk, which is very uncertain, they're even less inclined to provide insurance. And as you point out, the insurance premiums are so high that a lot of the governments there can't really afford them.
So how come Jamaica had a cat bond?
Well, Jamaica had a cat bond in 2021 that was issued by the World Bank. And it didn't.
So the World Bank paid the premium. That's why.
No, in this case, it was rich countries, including the US, UK, and Germany, that helped to pay Jamaica's cat bond premium. Jamaica renewed the cat bond earlier this year, but this time they didn't get any help on the premium.
And Jamaica thought it was still worth paying the premium?
Yeah, they did, because, if Jamaica got hit by a really big hurricane, the cat bond would pay out, in their view, because it would potentially hit the threshold.
And then it did not, and they didn't get the payout.
No, as I said, a cat bond is almost an all or nothing type of proposition. I mean, you can get partial payouts, and in the case of the Jamaica cat bond, if it had hit a certain lower threshold, it would have gotten a $30 million or a $50 million payout instead of the total $150 million that the cat bond was issued for. But in this case, the pressure reading that was taken from the storm just missed what the threshold was, and so there was no payout.
Did Jamaica get anything in insurance from a hurricane peril, given it was the worst that they have suffered?
Jamaica actually is a pretty pioneering country when it comes to protecting itself from these kind of events. And so they built up a $1.6 billion disaster financing mechanism across cat bonds, parametric insurance, and various other types of lifelines that they've procured. So overall, I think they were actually quite well protected. But the cat bond was a very important part of it, $150 million potential payout, which they didn't get a penny from.
And so we've been talking about these many layers that you can build to try and protect yourself from risk. But at the end of the day, from the perspective of Jamaica, it is really about protecting people. Do people know what cat bonds are and the fact that they didn't trigger and they didn't get a payout? And what did they feel about it?
Well, we spoke to quite a few people on the ground in Jamaica, and nobody had any idea what a cat bond was. They had no idea they actually had this potential protection that their government had bought for them with taxpayer money. So when it was explained to them how it would work, they were sort of horrified that their homes had been destroyed and their livelihoods had been hit, and yet they had received no insurance payment, even though there was this instrument out there that was supposed to protect them.
And our colleague Jim Wiz also spoke to Jamaica's leader of opposition, Mark Golding, about this.
Pull out a door for me. Thank you. Hello?
Hello, with Mr. Golding, please.
Yes, this is he.
Because after all, it is the leaders of the country that are paying for this cat bond. And
It sounded great and all that, providing the country with some cover in the event of a serious calamity. However, as we have discovered with peril, the country can be hit pretty hard by a natural disaster like a hurricane and suffer extensive damage, and the relevant trigger of payment is not met.
well, clearly the leaders are frustrated because they paid for something and they didn't really benefit from it. Is Jamaica and Hurricane Beryl a singular example?
There have been other severe weather events where cat bonds haven't paid out. So, for example, the Philippines, which relies quite heavily on these instruments, took out a cat bond, and it was hit by 2 or 3 typhoons recently, and it only got a partial payout, and it decided not to renew its World Bank cat bond. A more interesting example occurred in 2014 when Hurricane Odile smashed into Mexico. Mexico had a cat bond. Now, the decision whether the cat bond would pay out is based on what the National Hurricane Center measures. But in this case, they didn't have the best assessment of the pressure of Hurricane Odile.
And that's not surprising. Like, developing countries typically have far fewer weather stations than developed countries do. There's a map you can look at, and it's sort of like fully covered in rich countries and then very sparsely covered in developing countries, right?
Not only that, I heard that in this case, because they wanted to protect the weather stations on the ground, some of the weather stations had been boarded up and packed away to protect it from the oncoming hurricane. So there was no pressure reading on the ground stations in certain cases. So the National Hurricane Center then relied on a reading taken by an amateur storm chaser called Josh Morgan from the US, who happened to be in this part of Mexico chasing Odile.
Huh.
And his contribution of the pressure reading helped to determine that the threshold for the cat bond to trigger was not reached. And so he was actually really livid about this later on, wrote a letter to the Los Angeles Times describing how he had unwittingly been responsible for not allowing Mexico to make a claim on its cat bond, and how a pressure reading should not be the measure of a hurricane's destructive force.
If we take a big step back, we've been talking about risk and trying to insure against risk. Now, The way most insurance instruments work is by pooling risk across time or across geography, and that allows for both the insurance companies to be solvent and to make payments as they come through. Now, Avinash Prasad, who is an economist from Barbados, told me that climate change is an uninsurable risk because the main ways in which you could pool this risk across time or geography aren't working, because across time we are heating the planet and so the risks are going up. And across geographies, well, climate change is happening everywhere at the same time. And so he just calls climate change an uninsurable risk. Is that right?
I'd say for the most part that's correct, because traditional insurance would require people in poorer countries paying a pretty hefty premium to protect their homes and their livelihoods from weather-related calamity, and that doesn't really look like it's practical or reasonable in coming years. There is the possibility of parametric insurance, which also operates somewhat like a cat bond in a more modest way, but even that only covers a very small portion of potential losses. So in terms of insurance, I think we're between a rock and a hard place.
And yet rich countries want to find a way to stretch an insurance instrument into really trying to help developing countries, right?
That's right. 2 years ago, an instrument called the Loss and Damage Fund was put forward. It's a pool of money from wealthy nations that supposedly will go to poorer countries to help to alleviate their climate losses. That fund doesn't have much traction yet.
It's got about $700 million. And, by any count, climate damages for developing countries are in the tens of billions of dollars annually.
That's right. So there's been talk, we understand, of perhaps using that $700 million to partially or completely pay for premiums for a large cat bond to protect poorer countries against climate losses.
In a way, it's something that has been tried in the past. Before the loss and damage instrument, Germany led the creation of this thing called the Global Shield, which set out that it's going to try and pay insurance premiums for helping developing countries. The way rich countries are seeing it is they pay a small amount and then the private industry provides the larger payout. But this can only go on for so long, right? Because eventually that payout has to be met with the premiums that add up to the payout. So if climate change is uninsurable, what is the way in which developing countries can deal with climate damages?
Well, one of the most obvious ways is a loss and damage fund, whereby richer countries simply pool money and put it into this fund, and it's paid out whenever crises occur in the less developed world. There are also other supporting instruments that can be used. Cat bonds is one of them. Parametric insurance in a modest way is another one of them. There are also certain debt clauses that poorer countries that have a very high level of debt can use. So, for example, Grenada recently was able to, in the aftermath of Hurricane Beryl causing a lot of damage, they was able to defer interest payments on their debt for a couple of years. And that gives them some temporary relief to allow them to rebuild after the hurricane hit and continue their interest payments 2 years down the road.
And these countries typically have quite a lot of debt, and so they are paying a good chunk of money. Sometimes it's 10%, 20% of their GDP that is being paid in just interest payments for the debt they've taken on. So getting a pause allows them to have sort of cash in hand immediately to help with recovery. It does seem like finance can help deal with some of the climate damages that are coming, and yet at the same time, it's also showing that there are limits to financial instruments for how far they can go to deal with a worsening crisis.
Yeah, the issue here is that a lot of these insurance-based products are sort of based in the Western style of a market-driven product, right? And climate risk is not as amenable to being solved by some of these instruments because it's a risk that's escalating. There's a great deal of uncertainty. The insurance payments that poorer countries need to make aren't always affordable by them. They're already indebted, as you pointed out. So these market-driven solutions that the Western world has used for decades very, very well and has really been a very efficient tool doesn't quite cut it in the poorer parts of the world.
Thank you, Gautam. And I hope that people will read the Uncovered series that you and colleagues across Bloomberg Green have been reporting on both the potential but limits of insurance to protect against climate change.
Thank you, Akshat. It's been a pleasure being on your show.
Thank you for listening to Zero. And now for the sound of the week. That is Hurricane Milton making landfall. If you like this episode, please take a moment to rate or review the show on Apple Podcasts and Spotify. Share this episode with a friend or with someone who gambles. You can get in touch at zeropod@bloomberg.net. Zero's producer is Maithili Rao. Bloomberg's head of podcast is Sage Bauman. And head of talk is Brendan Newnham. Our theme music is composed by Wonderly. Special thanks to Aaron Rutkoff, Shawan Wagner, Jessica Beck, Ethan Steinberg, and Monique Mulima. I am Akshat Rathi, back soon.